one of the most important factors in qualifying for a mortgage and ultimately finding the best mortgage product for you and your home buying journey is your debt to income ratio, or as we refer to it, your DTI. Welcome to the Fairway Mid-Atlantic YouTube channel. If you're new here, welcome. If you've been here before, welcome back. Either way, I'd absolutely love for you to hit that subscribe button right down below so you don't miss another video from us. Our goal is to give you the tools you need to start your journey towards home ownership. We post a new video every Friday all about the home buying process, the real estate and mortgage industries, personal finance, and so much more. A couple weeks ago, we did a deep dive on credit and how it affects the mortgage process. We talked about what makes up your credit score, how your credit score could be positively or negatively impacted, and how it factors into creating your final mortgage picture. It's incredibly important to get familiar with your personal financial picture because, as we've mentioned before, buying a home is likely the largest financial investment you will ever make. So let's talk more about what your debt to income ratio is and how it affects the mortgage process. What is DTI? Debt to income ratios, or DTI, is a calculation that your mortgage lender will use to help you qualify for your home financing. It's a percentage that describes how much money you spend paying monthly debts versus how much money you are earning. Your lender calculates this by dividing your monthly debts, the debts that would show up on your credit report, by your gross monthly income. That's your income pre-tax. When you apply for your mortgage, your loan officer is evaluating your entire financial picture to determine if you are realistically able to buy a home and pay back the mortgage on it. Lenders operate based on risk, and the lower your DTI, the more confident the lender can be in your reliability as a borrower. But what is a good debt to income ratio? Well, good is all relative. Maximum DTIs can vary from program to program, but a good rule of thumb is that your DTI should never exceed 45%. As we've talked about before in our video all about loan products, which we will pop a card to right here, each loan product comes with its own set of guidelines for qualification. This means that each product has a different max DTI allowed to qualify for the program. For more information on mortgage products and which might be the right fit for you, head to our website, fairwaymidatlantic.com, to browse through all of the available options to you as a home buyer. But don't think you have to navigate it alone. Your loan officer will help. While 45% DTI may be approvable, it is more important to ensure that you are comfortable with your monthly mortgage payments. You do not want to be in a situation where you're house rich, but cash poor. You also want to budget for savings, future purchases, college educations, etc. Ensuring that you keep your new monthly housing payment DTI in a range that allows you to continue to save for the future is extremely important. But how do you calculate your own DTI? While you certainly do not need to know how to calculate your DTI like your loan officer will, it can be beneficial to roughly know where your DTI stands before starting the home buying process. As a consumer, you can easily calculate your DTI by determining what accounts show up on your credit report. Mortgage loans, auto loans, credit card minimum payments, personal loans, student loans, etc., and dividing that total by your gross monthly income. You do not want to include reoccurring expenses like your utility bill, savings account contributions, or retirement contributions. You only want to include those expenses that are recurring, required, and regular to determine your minimum monthly payment. Let's look at an example. To start, let's say you make $54,000 per year, or $4,500 per month. For debts, you pay rent, which is $1,200 monthly, student loans, which are $300 monthly, a car payment, which is $150 a month, and your minimum credit card payment is $200 monthly. You add it all together, and your debt equals $1,850 per month. Now, you divide your minimum monthly payment by your gross monthly income and convert that to a percentage to find your DTI. So $1,850 divided by $4,500 equals 0.41 or 41% DTI. This is an easy way to get an idea of what your DTI is going into the home buying process. but your loan officer will do the official calculations to determine the best mortgage product available for you. This is just another aspect of your financial picture that plays a role in determining your final mortgage product. Getting comfortable with your finances and understanding your specific situation will give you more clarity and confidence in choosing the right home and financing for you. If you are ready to start the home buying process or want to learn more about DTI or credit or anything else involved, head to our website, fairwaymidatlantic.com today and contact one of our loan officers. Thank you so much for joining me today. I hope this video gave you just a little more insight into the mortgage process. Leave a comment down below or give this video a big thumbs up if you want to see more videos like this. And again, we'd love for you to subscribe to our channel so you don't miss another video. Thank you so much, and we'll see you next week.